I'm Olivier Blanchard. I'm the head of research at the IMF and the Economic Counselor. Let me start by stating what has become obvious in the past few weeks. The world economy has entered a major downturn. While there is substantial uncertainty, our forecast is that world growth will be around 3% in 2009. That's its slowest pace since 2002. Now, this number hides an important difference between advanced countries on the one hand and emerging and developing countries on the other. We predict that growth in advanced countries will be very close to zero until at least the middle of 2009, with a very slow recovery during the rest of the year. World growth, instead, will be driven by growth in emerging and developing countries. But we predict that even there, these countries will grow at a substantially lower rate than they have in the recent past, 7% in 2008, 6% in 2009. Now, where does this slowdown come from? Well, over the last few years, the world economy has been hit by two extremely large shocks. Oil and commodity prices have shot up, and while they have stabilized, they have done so at high levels. The financial crisis, which started a year ago, has gotten steadily worse, and unfortunately, its effects on the real economy are still largely to come. Let me take oil and commodity price increases first. There were good reasons to fear that they would lead to a major stagflation, that is, a large decrease in activity, a large increase in unemployment, and a large increase in inflation. And this is what they had done in the 1970s. Well, this time, the world weathered the shock much better. In advanced countries, the effects on both output and inflation have been limited. In emerging and developing countries where the share of food and energy is much larger, the effects on inflation have been much stronger. But if this were the only shock, one could feel confident about the future. The other shock, and clearly the major news at this point, is the financial crisis. The essence of a well-functioning financial system is trust. I lend you if I can reasonably expect that you will repay me later. That trust is largely gone. Major financial institutions do not want to lend to each other, and when they have cash, they prefer to keep it rather than lend it to firms or households. Now, as we speak, plans are being put in place in many countries to help resolve the crisis. They have to and do include many dimensions, from the provision of liquidity to the purchase of assets to injections of capital. While there's still a lot of uncertainty about the details of these plans, one can reasonably hope that they will contain the crisis. But even in this case, trust and in turn credit will come back only slowly. And so for a long time, credit will be tight, slowing growth. Now, this is why we predict very low growth in advanced economies. And it is also why we predict lower growth in emerging countries. All emerging countries are going to face lower exports as a result of the slowdown in advanced economies, and some may suffer sudden stops, the sudden reversal of capital flows. Now, those with high reserves, strong fiscal positions, will be able to weather the storm, but others may definitely suffer large decreases in growth. Now, what about the role of policy in that context? Well, it is too late for policies to avoid the slowdown. It's already here. But strong policies can avoid even worse scenarios. In the short run, systemic financial plans are key. And in many countries, monetary and fiscal policies can help soften the effects of a decrease in demand. With such policies in place, it is reasonable to expect recovery to start in 2009 and then gather strength in 2010.